Trading prisoners like cattle, the commercialization of the justice system. Introduction, a system of profit, not justice. In the modern United States, incarceration has evolved into a profitable enterprise, closely tied to the issuance of municipal bonds, the investment strategies of financial institutions, and the commodification of human lives. From minor infractions to serious offenses, each criminal charge is embedded with commercial value and used as collateral for financial gain. Crimes as commercial instruments. All crimes are treated as commercial events that trigger the creation of bonds. These bonds are then monetized to fund everything from city infrastructure to court operations. The judicial process itself becomes an annuity, an investment vehicle that generates revenue for the government. Every jail sentence, probation term, or court proceeding is effectively a transaction in a financial system designed to profit from alleged violations of statutes. Military service and death as financial assets. Soldiers, airmen, and Marines are considered national assets with life insurance policies that may reach tens of millions of dollars. These government-held policies contribute to the monetization of military personnel. War zones like Iraq and Afghanistan have become long-term investments, less motivated by national security than by ongoing financial return. The 144 Rule and Securities Restrictions. The Securities and Exchange Commission, SEC, Rule 144 restricts the sale of unregistered securities. Prison bonds fall into this category and are treated as private investment vehicles. These securities must remain unsold for a holding period, typically 6 months, before they can be traded. This regulation plays a key role in how inmate-related securities are processed and distributed on financial markets. The role of Corrections Corporation of America, CCA. Companies like the Corrections Corporation of America, now CoreCivic, issue stock that represents prisoner accounts. Major shareholders include corporate executives and institutional investors. Through the pooling of inmate-related bonds, these stocks are bundled and sold as mortgage-backed securities and mutual funds on the public market. Securitization of prisoner accounts. Bid bonds, performance bonds, and payment bonds form the foundation of these financial instruments. Surety companies underwrite the risks, while investment banks handle distribution. These instruments are marketed to the public through stock exchanges and brokerage firms, transforming individual case files into debt instruments, equity assets, or securities. Legal bonds, recognizance and obligation. Every criminal statute is treated as a bond or obligation of record. When a defendant signs court documents at sentencing, they effectively authorize a financial instrument. This bond becomes enforceable as debt, and its value is monetized. The prison sentence becomes the means of collateralizing that bond. From war bonds to prison bonds. Historically, governments raised funds through public bond sales, such as war bonds. Today, instead of requesting voluntary contributions, they extract financial value through statutory violations. When an individual is accused and does not fulfill the commercial procedure for settlement and closure, they are placed into dishonor. That dishonor is sold on the market. Imprisonment as collateral. In lieu of full settlement of the alleged debt, the state uses imprisonment as a guarantee. The living person becomes the surety for the commercial bond. Courts require an acceptor for liability. If the accused does not properly accept and settle, the system assigns liability through incarceration and then sells the resulting bonds. Privatization and institutional involvement. Prison systems are increasingly privatized to reduce costs and increase profits. Institutions such as Fidelity Investments, Paine Webber, and the American Legislative Exchange Council, ALEC, are major players in prison securitization. Cornell Companies, Reed Trinity Ventures, and Warburg investment entities have all merged to streamline this monetization of incarceration. Theft of exemptions and intellectual property. Corporations often file tax returns, e.g., IRS Form 1096, on behalf of prisoners to capture their tax exemptions and claim prepaid interest. This form of identity-based financial exploitation turns prisoners into unwitting financial contributors, with their exemption being monetized without informed consent. Legal fiction and the Strawman construct. The court system functions under a duality between the living person and their strawman, a corporate fiction identified by an all-caps legal name, e.g., John Doe. The state holds title over this entity and operates judicial proceedings under the presumption that the defendant is a representative of this artificial construct. Courts, dishonor, and the UCC. Under UCC 3410, the system seeks an acceptor of liability. Legal dishonor occurs when a defendant fails to engage in proper commercial procedure, often by arguing or refusing to settle. The attorney's role is not to secure freedom but to ensure the dishonor process proceeds, allowing bonds to be issued and sold. Warehousing the body, admiralty law and bailment. Incarceration is structured under admiralty law principles. The term warden reflects maritime origins, a warehouse manager overseeing property storage. A prisoner becomes the bailed property, with commitment orders acting as contracts for warehousing the human asset. Conclusion: a system hidden in plain sight. This system, built on legal fictions, corporate finance, and dishonor, operates without the public's informed understanding. Recognizing this structure is the first step toward reclaiming legal agency, challenging commercial exploitation, and addressing the financialization of human lives.